The end of a financial year is a stressful time for any company. They must create their year-end financial statements and close out certain of their accounts. This resource will consider the required year-end financial statements for publicly traded companies and explain what should be included in the notes to those financial statements. We will also discuss the process of closing accounts, going through an example in its entirety. Publicly traded companies are required to release certain financial statements annually by law. These statements are the balance sheet, the income statement, the statement of retained earnings, and the notes to the financial statements. We have considered the balance sheet and the income statement in previous resources. The statement of retained earnings basically explains what stock the company has released, including its value, how many shares are outstanding, and any other value that the stock has earned the company. This statement acts as a bridge from the income statement to the balance sheet. But what is included in the notes to the financial statements? The notes first include what assumptions are made in creating the financial statements. Companies have some leeway in how they maintain their financial records, but those methods must be divulged. Does a company use LIFO or FIFO when calculating their inventory? Is depreciation calculated straight line or some other method? How and when does the company recognize revenue? Similarly, the notes also explain how the financial statements are prepared. One final piece of information included in the notes is any situation that may have future impact on the company. Are there pending lawsuits against the company? Does the company have plans to expand operations, which would provide context to loans and other transactions made? In total, the notes support and augment the summarized numerical information provided in the financial statements. Certain accounts for a company are referred to as real accounts. These are long-term accounts that should be maintained since the inception of the company. These accounts are found on the balance sheet and include the assets, liabilities, and owner's equity accounts for the company. Other accounts, however, are more temporary. These nominal accounts are designed to be more short-term, as they track movement during a specific accounting period. They are actually accounts that ultimately affect the retained earnings, but are specifically reported on the income statement. These nominal accounts include the various revenues, expenses, and also the dividends paid by a company in a given accounting period. Because these accounts only report for a given time period, they need to be closed or zeroed out at the end of that particular accounting period. How do we close these nominal accounts? To close the nominal accounts, first we actually create a new account. Income summary is a temporary holding account that we will use to transition from the original nominal accounts into retained earnings. For each nominal account, first we enter a transaction for the balance of the account on the opposite side. For example, an expense account with a positive balance will have a debit balance. To close the account, we would enter a credit in the same amount. This forces the total in the account to equal 0. This credit to the expense account is matched by a debit to the income summary. After all the nominal accounts are closed, we then close the account summary, matched by an entry to the retained earnings. Let's look at an example. At the end of their financial year, Polly's Plushies have a number of nominal accounts that need to be closed. The revenue account had a credit balance of $375,000. The salary expense, cost of goods sold, and insurance expense accounts had debit balances of $125,000, $150,000, and $50,000 respectively. We also know that the beginning balance for retained earnings was $380,000. We need to close the nominal accounts to the retained earnings. The easiest way to approach these problems is to consider the T-tables. This allows us to determine whether each transaction gets entered as a debit or credit, and also ensures that we zero out each account. Note that the revenue and retained earnings accounts have credit balances, the expense accounts all have debit balances, and the newly created income summary has no balance. One at a time, we will close the nominal accounts into the account summary. First, let's close the revenue account. It had a credit balance of $375,000. To zero out the account, we need to put a matching amount as a debit. This forces the overall balance to be zero. Because we entered a debit amount, we match that transaction with a credit to the income summary. Now we will close the salary expense account. It started with a debit balance of $125,000. To close, we put an equal amount as a credit with a new balance of zero. The debit entry is matched by a credit of $125,000 to the income summary. Next, we close the cost of goods sold, which had a debit balance of $150,000. We enter a credit in that amount to zero the cost of goods sold, matched by a debit to the income summary. Our final nominal account is the insurance expense. Like the other expense accounts, we enter the original debit balance as a credit entry. In this case, the entry is for $50,000. This is matched by a debit entry to the income summary. Now we will find our balance in the income summary. We have $375,000 on the credit side. On the debit side, we have entries of $125,000, $150,000, and $50,000 for a total of $325,000. So the overall balance for the income summary is a credit amount of $50,000. As a final step in closing the books at year end, we must close the income summary. Since we had a credit balance, we enter a debit entry of $50,000. This zeroes out the income summary. The entry is matched by a credit to the retained earnings account, which will have a new balance of $430,000. Now that we have zeroed out all our nominal accounts, we need to create our general journal entries. As these are all year-end entries, they are all dated December 31st. Our first entry shows that we debited revenue $375,000, matched by a credit to the income summary account, in order to close the revenue account at year end. The next entry with a debit of $325,000 to the income summary, matched by credits to the salary expense for $125,000, cost of goods sold for $150,000, and insurance expense for $50,000, close out all the expense accounts. Our final entry debits the income summary, $50,000, matched by a credit to retained earnings. This is done to close the income summary account. And with that, we have successfully closed the books for Polly's Plushies at year end.